Welcome back to the Williams Real Estate Channel. I am your host, Geordie Williams. Today we are going through a bit of a market update for May 2024, and then I'll give you a forecast for the remainder of this year and the coming years based off the 18-year land cycle. So to kick it off, we'll go through some CoreLogic data. We are well and truly in a stable upturn nationally. Another month of gains. As you can see, the largest gain since around August, September last year. So broad-based expansion is underway, and we have well and truly regained the losses in 2022, and the market is up 12% from when the market commenced its upturn in February 2023. So the main drivers of the national index is coming out of Brisbane, Adelaide, and Perth. We're still buying in Brisbane. It is very competitive though. Property selling within a week or two as of going on the market. So we are really working the relationships that we have with our sales agents to get pre and off market properties. Very competitive, very challenging to get property for under bank value because essentially the market has moved on from the CoreLogic and RP data valuations. So they typically lag 6 to 12 months, they get updated. And when the market is in a strong upturn, the sales data is ahead of what the actual valuations are. So it is more challenging to get properties now for under bank value in Brisbane. Adelaide and Perth, those ships have well and truly sailed. For us, we're not buying there. I mean, once it hits mainstream media and everyone starts talking about Perth, then you know that it's the market has well and truly moved on. You want to get into the markets before they go through their solid growth cycles. So we are now doubling down in Victoria, Melbourne, and Sydney is where we are really focusing for probably the next 10 years. I'd say probably the back end of 2024 and as of 2025, I won't be recommending to buy in Brisbane anymore because you pretty much almost missed the boat, and only focusing on Melbourne, Victoria, Sydney, and regional New South Wales to capitalize on the next growth cycle they will have, which will commence around 28 to 2030. So good time now to start doubling down into those markets in Sydney and Melbourne and the respective regions. Also noting that I like to get into markets that are suppressed, so you can get the properties for under bank value at a very good discount. Because down in Victoria, for example, properties sit on the market for 90 days plus, especially if it's multi dwelling housing, like a block of units. They sit on the market for 6 to 12 months, so you can negotiate very good prices for those properties because they have very little competition down there. And with the broad blanket $50,000 land tax threshold in Victoria, that is also suppressing the market even further. So I do see probably the next 4 to 5 years of this stagnation and moderate to no growth down in Melbourne, Victoria, but that is when you want to buy. You want to buy when it's soft and suppressed, and then you want to hold it through a significant market upturn, refinance during the big upturn, and then deploy it into the next market that is soft. So that's what I'm doing. I'm refinancing all my loans and against the properties out of Brisbane and Queensland, and then deploying the capital into Melbourne and Victoria while they're suppressed, as well as Sydney in certain pockets. Some pockets in Sydney are outperforming and keeping the broad numbers buoyant, but there are other markets where there's still very good value and opportunities to be had. Hobart, Darwin, Canberra, those markets I really don't operate in. I only really operate in the markets that Harry Triguboff operates in, and that is Sydney, Melbourne, and Brisbane, Gold Coast. Um, Maybe in the next in the next land cycle, we may get into Adelaide and Perth before they go through their bull runs, but for the next 5 to 10 years, we're only focusing on Sydney, Melbourne, and Brisbane tail end as of next year, probably leaving Brisbane out of the equation. Dwelling approvals rate is still very low. This is multiple factors: high labour costs, high material costs. Also, councils are very reluctant to approve construction of new development. I've actually experienced this recently. I've got two DAs in to build secondary dwellings or even granny flats, and because there's so much legislation and layers of bureaucracy, nothing really complies because it's all out of date. So if council doesn't want it, they can easily hide behind the legislation, say it doesn't comply here, it doesn't comply there, therefore it's rejected. So it's almost a part of the game of development or getting a development application approved is to justify why the new construction or the development is required. And now the main source of commentary is obviously we're in a supposed housing crisis with a lack of supply. So councils, yes, are very restrictive on the approvals as well. And then when you add the insult to injury with high cost of labour materials, not making development stack up in the first place, then it's sort of dormant. The construction industry is really plateaued out, and there's definitely not as many cranes in the cities in the current days. So compared to back in the 2015, 2016, 2017, where there was a big construction boom, it is very suppressed. So when there's a restriction of supply and a high demand, prices will continue to keep rising. So this is a bit more data from my housing market. So this also shows for unit prices, the strong growth is coming out of Brisbane, Adelaide, and Perth. Very well. And Melbourne, very flat, stagnant, and Sydney. So you want to be counter-cyclical. You want to get into the markets where they are suppressed and then you hold them through an upturn. You don't want to be like 99% of people who rush into the market where everything's booming and going crazy, because you'll get in, you'll overpay, and then it'll take you another 10, 15 years till the next up cycle to then really get the growth. You want to get in when it's flat and going backwards, because then you can negotiate good discounts, you can make money on the way in, you can buy the properties for under bank value because there's less competition. And then when the market really warms up and kicks into gear and goes into the upturn, that's when you make your real cream on the cake. So if you rush into markets like Perth and Adelaide, and Brisbane's even getting there now, you're almost overpaying and not getting those gains because the market has risen so much in the last couple of years. However, most people only like to get into a market once it's starting to go through a solid upturn. So the only caveat to that I would say would be Brisbane still has probably about halfway through its upturn and or two-thirds, I'd say. So if you're looking to get a quick lick and quick refinance, you can still get in now in Brisbane. But as of next year, I would be saying the market's about to top out, and you might as well look at Melbourne and Sydney and their respective regions to capitalize on the next upturn, which I'll show you based off the 18-year land cycle. Same for houses. Um, so strong growth out of Brisbane, Adelaide, and Perth, and stagnation backwards market in Melbourne. Great time to buy, and Sydney, a bit more buoyant. So those are the two markets that we're, as I said, we're looking to double down the next 5-10 years. The reason for that is the 18-year land cycle. So the 18-year land cycle is an average land cycle. It's never been less than 17 years and never more than 21 years since 1800. And then we use it as a framework to work out at a macro level what market to focus on. We obviously like to get in to the market before it goes through the bull run. So as of 2025, we are no longer going to be buying in Brisbane and regional Queensland. I will be refinancing and developing, though. That's a different story. It's time to start subdividing, building second dwellings, because you're adding new stock, creating new supply, creating new property for half the cost of buying a new property. So, for example, we've been buying houses for that 250 to 300 mark. Once they double in value and then they're worth 600, you can subdivide, build a second dwelling or granny flat for half that cost. So you can still get into that market, provided you have already an asset in that market, and capitalize on the boom and the massive yields out of the rents rising, but not overpay, because you are essentially just you're creating another property from scratch. So it's a build to rent model on the back of a buy and hold. So buy and hold, buy property, rent it out. Once the market moves and doubles, then look to develop the site by subdividing it, building a second asset to then rent out, because then you get the properties at a wholesale price. So that's what we're doing now in Brisbane and Queensland and some in New South Wales, provide the councils play ball. It is a long game. Legislation and planning changes over time to accommodate new higher density. So even though the DAs have been knocked back, it's not like I can never ever build them. At some point in time, I will be able to. I just have to run its course and follow the process, and maybe even take it to land and housing. Sorry, the courts to get overturned and approved at some point. So that's part of the process. But right now we are focusing on Sydney and Melbourne, because as the market tops out in 26, 27, then we go through the next land-driven downturn from 28 to 30. That's when Sydney and Melbourne will then lead in the next recovery or the start of the next 18-year land cycle. Copper price. So Dr. Copper, when copper starts to rise and it's nearly hitting its all-time high again, leading indicator that the economies around the world are starting to open up and demand is starting to drive for construction, manufacturing, development, and that is off the back of the land cycle. So the land cycle prices rise, and then it makes property stack up, and then it makes sense to start developing and building. And then once building and construction and starts to boom, and then manufacturing then comes off the back of that, the demand, copper rises. So if copper's going up, it's a leading indicator to show that the coming years are going to be very strong and bullish years for the markets, property markets, stock markets, all the markets. it's going to start booming. What's another thing that's going to give me confidence on the years ahead is the tax cuts that are coming in as of July. So as of 1st of July, a reduction from 19% tax rate to 16% uh, for up to 50 or 60,000. Hasn't actually got it on the screen there. And then a reduction from 32.5% to 30%. That's probably up to, I'd say, 80,000, and an increase to 37% tax threshold from 120 to 135,000, and increase the 45% tax threshold to 180 to 190. So they're increasing the threshold, so it allows people to make more money, disposable income. So those tax cuts, I've actually recently spoke to my mortgage broker, and he's saying it's as much as a 1 percentage point in reduction to the cash rate. So it's going to allow people to have more disposable income. It's going to increase their serviceability. They're going to be able to take out larger loans. So they're going to be able to pay more for property. That's all going to filter down to the benefit of land price. If you've got more money to spend, they're going to spend it. It's the law of economic rent. So land price and property is going to soak up these tax cuts. So even though the government's trying to essentially give people more money to help them with the supposed cost of living expenses, that extra money is all going to get soaked up with higher property prices. The budget, so the government also has raised, or is raising for 2024 revenues from individual income tax, so the main portion of that, and company resource tax, to then deploy into a big portion of is social security and welfare, which is essentially rental support. So another way that government is looking to support people who are renting is to provide them more money and rental support. What happens then? They can pay more for rent. If they got more money to spend on rent, rents will rise. And then rents will rise. And when rents rise, it increases the value and the earnings of a property. So the yields increase. When a yield increases, then the property values increase. You'll never find a residential house or a unit that has a 15 to 20% rental yield. And the reason for that is as the rents rise and the yields rise, the values then follow then on after, typically 6 to 12, 18 months after the rents rise. So as rents rise, it's a good leading indicator that prices will then follow. So when you give people more money to spend on rent, it'll also then get soaked up by higher rents. Higher rents will then capitalize into higher property prices. That's another good leading indicator to show that the market is going to keep moving on. The cash rate. So cash rate's on hold at 4.35%. I don't see it coming down this year, and probably not until the market tops out 26, 27, then I see it dropping. If it drops next year, then it's going to be boom times. It's going to be crazy. But the inflation rate is still hovering at 3.6%. It's coming down. So once it's within that band, it'll give the RBA more confidence to drop the rate. But if they drop the rate, that's only going to be stimulating an inflationary anyway, and then they'll kick off inflation again. So I don't see them dropping it in the near future. I wouldn't say this year at all, and potentially next year, but that'll depend on what's happening in the United States. Brings me to the United States. So historically, Australia trails 6 to 12 months behind the States. Jerome Powell is adamant to maintain the cash rate at 5.5%. Inflation's coming down, is at 3.3%. However, the United States has a target of 2% to maintain inflation below 2%, where Australia has a target band between 2 and 3. So the US actually has a lower target to maintain, and they don't have a band, so it has to actually get under 2%, which is going to be quite challenging, especially with an economies around the world opening up after COVID and all the stimulus that is soaking through the system now out of COVID, with all the stimulus that has been pumped into the markets. It's going to be hard to get it and keep it under 2%. So I don't see rates moving down, especially while Biden is in power. So it's going to be probably the next year, I'd say, until potentially they might drop next year. And then Australia will then trail 6 to 12 months after that, which will bring us to 26. Market will top out. Potentially it might go another year, depending who's in power. And then once the market tops out and we go through the next land-driven downturn, GFC-like event, then they'll be dropped back to zero before you know it. So that brings us to politics. So reason why I want to bring up politics is because it really plays out and it has a big impact on the market. So if Trump comes in November, 4th of November this year, which even though he's getting a lot of black from the court cases that are supposedly being orchestrated by the Biden administration, he's really taken it in his stride. Trump is one of the probably best sales person and famous person in the world. So any publicity is good publicity, so he says. So even though they've been trying to lock him up and get him for technicalities of um, business taxation and business records, really is that there is no crime, but he's taking it in his stride, and now he's a convicted felon. In America, the society in America and the culture in America, they love outlaws. They love the outlaw. They love the underdog. So it's really the last couple of months of him being convicted is actually working for Trump, and he's taking it in his stride. So Biden, on the other hand, I don't know if he's actually ever going to make it to the starting line in November. He's definitely got dementia. You can see just in his mannerisms. So the way he presents himself, way he's speaking, shuffles around. So regardless of that, anyway, if depending who wins will determine on how the market plays out. If Biden wins and or Biden's party or someone else in Biden's party wins, the 18-year land cycle will more likely run its course of peak in 2026, and then we'll go through the next land-driven downturn. So it'll be a more or less an 18-year land cycle. If Trump comes in, he will cut taxes, cut regulations, apply tariffs, all of which is aimed at to boost the economy and boost the land cycle and the land market and the property market. He's a property developer. He's got vested interest in property. So his actions will be aimed at obviously boosting his own portfolio. And you can see that through his policies he's already talking about. So cutting taxes allows people to have more money. They can spend. It'll boost the economy. Everything will start kicking and roaring, and that'll all get soaked up with higher property prices. Cutting regulation, like lending regulations. this same period before the GFC in 2005, 2004, 2005, 2006, you could have walked into the bank and not even prove you had a loan. Sorry, not even prove you had a job and get $1 million loan drawn up before the GFC. That's cutting regulation. So after the GFC, Obama brought in all these regulations that you had to have all the documentation. You had to prove you obviously had a job. It made it very tight on regulation in terms of lending. As soon as Trump came in 2016, he cut all that. So he'll cut that as well. Cut when he talks cutting regulation, that's about lending regulation, because then that then boosts the economy and draws credit and expands the national debt, and that'll all get soaked up by higher property prices. Tariffs as well. He'll try and raise cash from other countries around the world in order to boost his economy or the US economy. If the economy is roaring, it'll all filter down to the benefit of land price. Another good point if Trump is talking about is he is looking to get rid of Jerome Powell, because Jerome Powell is quite a conservative when it comes to managing the cash rate, and he's trying to, or he's saying that if he comes in, he'll look to replace him or get a new head of the Fed, who would then more likely he'll try and get them to drop rates, because if they drop rates early next year, the whole market is just going to take off, which is overlaying this information is really making the 18-year land cycle play out and run its course, and even run further, like a 20 to 21 year land cycle. As remember, it's never less than 17 and never more than 21 based off history. So, and on average 18. So if Trump comes in, he'll do everything in his power to keep the market moving, kick the can down the road. So the boom will be even bigger and the bust will be even bigger as well. So the boom led up to the pre-GFC between 2004 2007. This coming boom is going to make that boom look like nothing. It's going to be absolutely off the charts. And then the next land-driven downturn is going to be a doozy. Just like probably what happened in 1991, the great recession we had to have. This is what it's probably going to look like. It's going to be very turbulent times ahead, especially if Trump comes in. So that's how I see the market playing out. Two ways. It's either if Biden's party wins, it'll more likely run its course, peak in 26, and then we'll go through a more modest land-driven downturn. If Trump comes in, he'll pump it for another 2 or 3 years. It'll go higher and it will crash even harder. But as politics plays out, I'm sure he'll be out of the White House before the commencement of the next land-driven downturn. Anyway, time will tell. Very interesting and historical moments ahead to witness, and pivotal times ahead. Just a disclaimer, this is by no means financial advice or general advice or any advice at all in nature. This is my story. This is my thoughts of how I see the market playing out. I can guarantee one thing though, if you don't take action, you will not get anywhere. Until next time, see you then. Thanks for watching.